Hello and welcome to day 14 of managerial accounting for the fall 2022 semester. As we look at our course schedule, and I finally found a place that I can show what's coming up effectively, so I'm happy about that, unless they change the look of Brightspace again. So we have the course schedule here under the table of contents, so that's an easy access for you. So as we look at what's due today, we have the chapter 20 problem because we finished chapter 20 on Tuesday. And then today we'll be starting the chapter 21. So the chapter 21 pre-quiz should also be submitted by the end of the day. And finally, step 2 of the annual report project is due today. We talked about that last week, so you should already know what is expected of you for that. There is a brief summary here on the Dropbox, and you'll also notice that these are hot links here. And so if you're on that course schedule, you can use those hot links to navigate around the course if they find that helpful. But an easy way to get to what you're supposed to be working on. Just as a reminder, no JCC classes Monday or Tuesday. So our next class after today will be next Thursday, October 13th, and we'll be finishing up chapter 21 at that point. So the chapter 21 exercises should be submitted at that time. Our second exam covers chapters 19, 20, and 21. And so after we get back from the fall break, and we'll be finishing up chapter 21 on Thursday. So the problem won't be due until Tuesday, the 18th. And so our second exam covering just those 3 chapters will be that following weekend, October 20th through the 23rd. So just looking ahead a little bit, I am going to look at my schedule for that week and try to find a time for a review session like what we had for the first exam. So if there's anyone here or anyone who's watching the recording, if you do want to attend a review session, you could just send me an email. Let me know what day time might work for you. And if there are people that I know would attend at a certain time, I would be happy to accommodate that if my schedule permits. I am starting next week. I think I told you this probably. But starting next week, my schedule will be changing a little bit. And so I'm going to have 1 extra class on my schedule that I have not had up to this point. And also it affects my Wednesday office hours. So I did include in an announcement what my new office hours are. They're also updated in Starfish. So if you're trying to schedule an appointment with me, everything that's there is still valid. Excuse me, but that will affect my availability for scheduling a review session as well. So I'll find time that week, but if you want to attend, let me know if there's a specific day or time that would work better for you. Before we start working on the new material, is there anybody who wants to ask a question from the old material? From chapter 20 on CVP analysis or anything else? Okay. Well, if there aren't any questions, we will turn to chapter 21. So you can see the title of this chapter is Variable Costing for Management Analysis. So this is a little bit different way of looking at our cost of goods sold, different than what we did in financial accounting and different than what we've done, a little bit different than what we've done up to this point. To change pages, you can see that we have a number of learning objectives for this chapter as always, and we'll be moving through the chapter sequentially like this, and we have exercises that deal with almost all of these learning objectives. So as I said, what we're doing in this chapter with variable costing is different than what we did in financial accounting. So what we do in financial accounting, what is required for US GAAP, is what's known as absorption costing. So we did not use that term in financial accounting. That was the only approach that we used. And so there's no reason to confuse the issue by throwing out unnecessary terminology. But now that we're introducing a different approach to costing our products, it's important that we recognize what we do under GAAP. Absorption costing means that all of the costs related to making the product, just the way we've been talking about it since the beginning of this class, all of those costs are inventoriable costs. They are attached or assigned to units of the product as we manufacture it. And those costs stay with the product on the balance sheet as inventory until we sell the product. At that point, it moves off the balance sheet and onto the income statement as part of cost of goods sold. And so just like we've talked about it since chapter 15, all products are going to include direct materials, direct labor, and overhead. In the last chapter, we really focused on, in part, the difference between fixed and variable costs. And I think it's very easy to see that our factory overhead or manufacturing overhead costs can be separated into those two pieces. So fixed costs are those costs that are going to remain constant or predictable, remain the same, regardless of the level of our production, regardless of how much we make. And variable costs are those costs that we incur only because we are making the product. So variable factory overhead would include things probably like the cost of any supplies or indirect materials, indirect labor. We wouldn't have those costs if we weren't making the product. They're going to go up if we make more of the product, go down if we make less of the product. So again, under absorption costing, all those costs we've been talking about starting in chapter 15, all of those costs are attached to the product. They're inventoriable or product costs. They stay on the balance sheet until we sell the product. And so what you see here should look very familiar to you as the approach to a multi-step income statement. Sales minus cost of goods sold equals gross profit or gross margin. Those terms mean the same thing. Then we subtract our operating expenses, selling, general, and administrative expenses to get our operating income. And the difference between operating income and net income, couple differences. Operating income does not include, it has not been reduced for any income tax burden, and any other non-operating items such as discontinued operations, effects of an accounting change on our records, extraordinary items. So operating income is our continuing income. These are the revenues and expenses that we expect to continue into the future. So with that summary of what absorption costing means and what that looks like, we now want to contrast that with the idea of variable costing, the focus for this chapter. So variable costing, just to be clear, is not acceptable for GAAP, for external reporting, for our financial statements that we share with the public as a publicly traded company, but it is useful for internal decision making. So you're not going to see this show up on, the company that you chose for your annual report project. When you look at their financial statements, you can be certain that when they say cost of goods sold on their income statement, they're including all of those costs, direct labor, direct materials, and fixed and variable overhead. When you look at the inventory amount on their balance sheet, that's again the full, all four of those product costs are included there. But that may not be the best way of making decisions. As we walk through these next few slides, next several slides, we'll see an example of why using absorption costing might lead us to a very poor decision for the actual health and well-being of our company. So what's different between absorption costing and variable costing? Well, there's one big difference, and that is how we treat that fixed factory overhead. Under absorption costing, that gets assigned to inventory. under variable costing, we treat that as if it's an operating expense. In other words, it doesn't get attached to the product. It's never considered part of the inventory. It is always expensed in full in the period in which it's incurred. We don't attach it to product. We don't inventory it. And so that is the difference between absorption costing and variable costing. And just as a preview very quickly, so if we produce exactly the number of units that we sell, remember in the last chapter, we said that was one of our assumptions for CVP analysis, that we're not producing for inventory, we're not selling down our inventory, everything we sell that period, we also produce that period and vice versa. If we do not change our level of inventory, there is no difference between variable costing and absorption costing. If we do not produce for inventory or sell down our inventory, there's no difference between the two. Okay, I need to clarify that. There could be a tiny little bit of difference if the costs change over time. One cost is higher 1 month and the unit cost is higher. But for the most part, the only time there's a difference between these two is if your level of inventory changes. And so you can see here visually what that would look like under absorption costing for external reporting for GAAP purposes. All of the costs are included, but under variable costing, the fixed factory overhead, those costs that we're going to incur whether producing product or not, are treated as a period expense. They're expensed in the period in which they're incurred. They go right to the income statement. They're not considered inventoriable costs. I left this slide in only because I wanted to introduce one new term to us, and that is right here in the center of the screen. Let me spotlight that for you. So right here, manufacturing margin is a brand new term for us. So we know what gross margin is, and here's another reason I don't like that they use gross profit, because you miss the parallels between gross margin, contribution margin, manufacturing margin. But this book refers to it as gross profit for some reason. So we know gross profit is sales minus cost of goods sold, or gross margin. We know from the last chapter that contribution margin is sales minus variable cost, where those variable costs include both product and period costs. The change, or the new information here, that the new interim step, if you will, is manufacturing margin, which is a step before contribution margin, as you can see here in this calculation. So we know from chapter 20, sales minus variable cost, which includes both of these two items, sales minus variable cost is contribution margin. But if we break those variable costs into, is it related to the product or is it a period expense? Sales minus the variable cost of goods sold, so only the product cost, only the variable product cost. Sales minus variable product cost is manufacturing margin. Then if we subtract the variable operating expenses, variable selling and administrative or period expenses, we get the contribution margin. And now we already know that that fixed manufacturing cost is going to be kept separate under variable costing, and then fixed selling and administrative expenses brings us down to our operating income. So everything we see here is information we've already seen, with the exception that, in the last chapter, we did not have this separate line in there for manufacturing margin. So another intermediate or interim step in our travels from sales down to operating income. Oops, I should have erased that red line. So again, very simply, this is our absorption costing income statement as we have seen it since chapter 5 in financial accounting for most of you. Sales minus cost of goods sold, so product costs separated from period cost. And then our variable costing income statement, which from the last chapter, we introduced the contribution margin income statement. Now we just have one more step, which is that manufacturing margin. To be clear, it doesn't matter whether we use a contribution margin income statement as we did for CVP analysis, a variable costing income statement, an absorption costing income statement. The bottom line, then the operating income remains the same. The only difference between those three approaches is how we break up or how we separate, how we assign the expenses. Do we break them up product versus period, fixed versus variable? Do we break the variable into two separate parts as we have here? Okay, any questions so far? Excuse me. And so I think this is common sense. If we make more units, if we make exactly the same number of units that we sell, then our inventory would remain the same, right? If we make more units than we sell, our inventory on the balance sheet would go up. And if we make fewer units than we sell, our inventory on the balance sheet would go down. So I don't think we need to spend any more time on that. Just want you to think about that. So making additional inventory, making inventory that's not needed for sales, not needed to meet demand, increases inventory on our balance sheet. When we pull the fixed manufacturing costs off the balance sheet, when we make them part of the period expenses, increasing our inventory is actually going to decrease our operating income. So what do I mean by that? And how does this help with management decision making? If we assign, let me go to an example here. So if we assign fixed costs to inventory, fixed manufacturing costs to inventory, what that means is if we produce excess inventory, in other words, inventory we can't sell, some of those fixed manufacturing costs are going to be moved over to the balance sheet. It's going to increase or inflate the value of the inventory. And so there's an incentive if management is being evaluated based on operating income, based on the value of our assets, for example, there's an incentive possibly to produce for inventory just so that the fixed costs move off the income statement. And you can see that in this exercise. So, or excuse me, in this slide. So what happened for this company during this period? Well, their sales, get my pointer up here. Their sales were 12,000 units. They sold 12,000 units, but they produced 15,000 units. The fact that they produced 15,000 units means if we use absorption costing, as we must for our financial statements, then some of the fixed costs are going to be attached to those 3,000 units of ending inventory, and they're going to go on the balance sheet rather than on the income statement, improving the bottom line on our income statement. And so what you notice here is absorption costing. When we shift some of those fixed costs we produced for inventory, Our inventory went up. That's what I mean when I say we produced for inventory, not because we could sell it, but because we had capacity and we figured, why not? Let's just make it, even if we can't sell it. So when we produced and increased our inventory, we shifted some of those fixed manufacturing costs from the income statement onto the balance sheet. Our assets are now higher, and our income is also higher because our cost of goods sold is lower. Under variable costing, producing extra units does not add to our bottom line. Producing for inventory does not help under variable costing because all of the fixed manufacturing costs, you can see it right here. We have $150,000 worth of fixed manufacturing costs. All of those costs hit the income statement under variable costing. But under absorption costing, some of those fixed manufacturing costs associated with the 3,000 units we added to inventory go on the balance sheet, reduce our cost of goods sold, and that's how we have a higher income under absorption costing than under variable costing. So, and we'll talk about this concept more in a later chapter, the idea of producing for inventory. But just to kind of get you started, plant the seed on that right now. In a perfect world, a company should be producing not because they have capacity, but because they have a customer. We call that concept pull-through production. And I'll write that on the screen. Pull-through production. Whoops. Pull-through production. The idea of pull-through production is you produce it because there's demand for it. You produce it because you have a customer. Not because you have capacity, not because you can, not because you have some equipment that's sitting idle, but because you at least believe someone wants to buy it. And in a perfect world, you'd get an order from a customer and then you'd produce for that customer. Now that's not going to help in all circumstances. You know, grocery stores clearly are not going to work that way. Any kind of a retail operation, you generally need to have the inventory sitting there, but at a minimum, you should be buying because you believe someone wants to buy it. You should be producing because you believe you have a customer, not because you hope there's a customer. We call that pull-through production, and that is a core principle in business management. It does not make sense. It is not good business decision making to produce because you can, or produce because you hope somebody wants to buy it. Generally speaking, that's not going to be beneficial. So this slide just explains what I've already explained to you. The reason that the difference between the operating income of 40,000 under variable costing and 70,000 under absorption costing is the $30,000 worth of fixed manufacturing costs that got shifted onto the balance sheet. And it's misleading. It's not a good business decision to produce for inventory. And so if we reward people for higher income, we really are incentivizing, we're encouraging them to produce for inventory to shift some of those costs onto the balance sheet. Okay. On the other hand, if you are in a situation where you are selling off your inventory, reducing your inventory, a manager should not be punished or treated unfairly because of that. And that's the situation we have here. We have sales of 15,000, but they only produced, how many did they produce? They only produced 10,000. And so they sold off 5,000 from their beginning inventory. Okay, so they sold the 5,000 from beginning inventory. They made another 10,000 and they sold all of those. So under variable costing, we are now including all of the, let me start with absorption costing. Under absorption costing, the beginning inventory, remember, had the fixed costs from a previous period, right? They were carried forward because that's how absorption costing works. All of the fixed costs remain with the product. And so this $35 per unit for the beginning inventory includes fixed costs that were not from this period, from this month or this quarter or whatever this statement covers. And so under absorption costing, the operating income is $50,000. We're basically being penalized for fixed costs from a prior period. Under variable costing, the inventory only includes the variable costs, and the fixed costs we see here are only from this period, rather than carrying forward from the earlier period on the balance sheet. And so operating income under variable costing is $100,000. Under absorption costing, it was only $50,000. $100,000 actually better represents what happened this period. We're rewarding our managers. If we're using these data to incentivize our workers, to reward management, this is good behavior from a manager, to sell off inventory, to only produce what we need to meet demand. Those are all good things for management decision-making purposes, and using variable costing allows us to recognize that, allows us to not hold them accountable for fixed costs from a prior period, and to punish is probably a little extreme, but to not recognize the true income resulting from what happened this period. And so we see that difference because under absorption costing, you are now, when you're selling off that inventory, you're now hitting the income statement with those fixed manufacturing costs, but which were not actually incurred this period. Okay, so I already told you this. If we sell the same number of units that we manufacture, there would be virtually no difference between the two. But if we manufacture more units than we sell, absorption costing is higher than variable costing. And if we produce fewer units than we sell, absorption costing is going to be less than variable costing. So this is just showing you that visually. It's completely related to what happens to those fixed manufacturing costs. Are we shifting costs to the balance sheet that we're not, that should be reported this period? Or are we shifting costs off the balance sheet that really were from a prior period? So with that background, let's go ahead to our exercises. And we'll get started with our first exercise here: inventory valuation under absorption costing and under variable costing. Before we start this, does anyone have any questions? Everybody good? Okay. At the end of the first year of operations, so if this was their first year of operations, what was their beginning inventory? 0. Yeah, they didn't have any beginning inventory. The end of their first year of operations, 21,500 units remained in the finished goods inventory. In other words, they built up an inventory during the year. The unit manufacturing costs during the year were as follows, and we have separate costs there for direct materials, direct labor, fixed and variable overhead. We're asked to determine the cost of the finished goods inventory reported on the balance sheet under absorption costing, required for GAAP, and under variable costing. So absorption costing, so Absorption costing is going to include all 4 of those costs, but variable costing is going to include just the variable costs, I guess, as the name implies, right? So absorption costing, all 4 of those unit costs, 30 plus 18 plus 22 plus 14. So that would be a unit cost of $84 each times the $21,500, or sorry, 21,500 units. And absorption costing, the value of the ending inventory would be $1,806,000. Under variable costing, we would include only the variable costs. We would leave out the $22 in fixed overhead. What happens to that? It goes to the income statement. Do not pass go, go directly to the income statement. Do not stop at the balance sheet on the way. So our unit cost there would be just $62 rather than 84 times the 21,500 units. Total value of that ending inventory, $333,000. A difference of about what, $470-ish thousand. Pretty big difference. Difference of about $470,000. And that means that our income on the income statement would also be different by that same amount. Absorption costings income would be higher because they have absorbed or moved all of those fixed costs onto the balance sheet as inventory. The current assets would be higher, so the total assets would be higher. Income would be higher under absorption costing. If we evaluate our management, if we incentivize them based on that number, the absorption costing number, we really are encouraging them to produce product that they do not have a customer to buy it. Now, I don't know if 21,500 units for this company is an overstock of inventory. For all I know, they may have sold 21 million units. Okay, so there's really no way that a brand new company could do anything but produce for inventory. I mean, unless they end the year with exactly 0, right? Their inventory can't go down, it can only go up. This may be too high, it may not be, we don't know because we don't have any other information about their process. But if they only sold 40,000 units and they ended up with 21,000 still in inventory, that's probably not a good way of running the company. That's probably not a good management of their inventory, but it would result in a higher income, even though they're actually spending more money because they're producing units that they can't sell or haven't yet sold, right? So they had to pay all the variable costs for those units that they would not have had to pay if they didn't produce them at all. Remember, the fixed costs are going to be there whether they produce those units or not. But the variable costs, the $62 per unit, those are costs that they could have saved, could have improved their cash flow by not making those units for inventory. Oops. So any questions at this point about the difference between absorption and variable costing? So we'll keep going. In exercise 2, we are asked to prepare income statements for Gallatin County Motors Incorporated. They assemble and sell snowmobile engines. The company began operations on July 1st and operated at 100% of capacity during the first month. The following data summarize the results for July. So it's a brand new company. They had 0 beginning inventory. They produced 4,350 units. They sold 4,000 of those units. So their ending inventory is how many units? If they produced 4,350 and they only sold 4,000, they have 350 units of ending inventory. When we use absorption costing, those 350 units are going to include all of the direct materials, direct labor, variable and fixed overhead for those units. But when we use variable costing, the entire fixed overhead, 130,500, right here in the center of your page, all of that under variable costing is going to be included on the income statement as a period expense. So we're first going to use absorption costing. Let me do just a quick calculation here. I'm going to write it over here on the side because we have a nice big white space there. So if I take our direct materials, direct labor, and variable factory overhead, I'm just going to add those together. I want the total of the production costs minus the fixed factory overhead. So I'm just totaling the variable costs. And I'm going to just make a note here. So we're going to need this calculation. So total variable cost, TVC, is the accepted abbreviation for that. We have a couple of people here taking economics. If you're taking microeconomics, that's a abbreviation, an acronym that you'll see routinely in that class as well. So that's our total variable cost. Our average variable cost, bless you, then would be that total divided by 4,350 units. I just want my unit cost, and it is $42 per unit. Oh, whoops, not 42 cents. Sorry, I forgot that I was being conservative with my zeros rather than having to constantly plug in all those zeros. $420 per unit. So average variable cost per unit, $420. I'm just going to do another calculation here in case it's helpful for us. Average fixed cost then would be the total fixed factory overhead of 130,500 divided by 4,350, and that would be $30 per unit.
How did you get that figure one more time?
Which one? The average fixed cost?
Yeah.
I took the 130,500 of fixed factory overhead,
Okay.
and divided by the 4,350 units that we made.
Oh, okay. Thank you.
So now let's look at part A. Prepare an income statement using the absorption costing concept. So this is exactly the same as what we have done since chapter 5 in financial accounting. Sales minus cost of goods sold equals gross margin or gross profit minus our period expenses, selling, general, and administrative, gives us our operating income or loss if our, so I'm going to leave that one blank. I'm not sure what that's going to be. We have our sales here of 2.6 million. Now we have to calculate our cost of goods sold. So how many units did we sell? 4,000. For absorption costing, we use the full cost. We use the not only the variable cost, which we know we already calculated is $420 per unit, but we also include the $30 per unit in fixed costs. So the 4,000 units we sold each had a full cost of $450. Cost of goods sold then $1.8 million. Everyone okay with where that came from? We include both the variable and the fixed cost, so that's a total of $450 for the 4,000 units that we sold. Leaving us a gross profit of $800,000. Our selling and administrative expenses combined are $85,000. And so since our gross profit exceeds the selling and administrative expenses, we have a positive operating income of $715,000. Which seems like a very healthy profit on sales of 2,600. Just saying. So nothing new there. Any questions on that though? Okay. So now let's take a look at the variable costing income statement. So this looks like what I showed you in the PowerPoint. Sales minus our variable cost of goods sold gives us manufacturing margin. That's the new interim step that we introduced today. Minus the variable selling and administrative expenses gives us our contribution margin. Then we subtract our fixed factory overhead and our fixed selling and administrative to get our operating income or loss. We know, I already told you. Oh, wait, never mind. I was going to say something that wasn't actually even true. I was going to say the operating income doesn't change, but this is variable costing and it is going to change. From absorption costing. I was just thinking of if we took the same income statement and put it into the variable costing approach, when there's no change in inventory. So our sales don't change. $2.6 million. Sorry, I underestimated how far over that was going to go. So please just ignore my blue writing there. The variable cost of goods sold, we already know the average variable cost per unit. It's right there next to where I am now, $420 per unit times the 4,000 units. That's $1,680,000. I didn't say in the top one, but if it helps you to remember to subtract, if you like the look of it better, if you just think it makes more sense, the software will allow you to put in negatives to remind you to subtract like that. As long as it doesn't say use or don't use negatives, it will accept that number either way. It will accept the absolute value of that number. And so we have a manufacturing margin of $920,000. The variable selling expenses were $60,000. So we have a contribution margin of $860,000. And here's where we have a difference. In the absorption costing income statement, this $30 in fixed cost, we only included the $30 in fixed cost for the 4,000 units that we sold. We are now going to include the entire amount of the fixed factory overhead, which was $130,500. Then we have the fixed selling and administrative, which was given as $25,000. And then we subtract. The total of the fixed costs from the contribution margin. And I can position it just like that so we can compare at least that bottom line. So what do you notice? Operating income is higher under which approach? Yep, operating income is higher under absorption costing. How much higher is it? 715,000 minus 7,045. $10,500. What is that $10,500? It is. It is this fixed cost of $30 per unit times the fingers on the wrong keys, 350 units that we produced but did not sell. Okay, so we produced 4,350, we only sold 4,000. We added 350 units to ending inventory that were not there before. Each one of those 350 units under absorption costing carried with it or absorbed $30 worth of fixed cost. And that's the difference between the operating income under absorption and variable costing.
How did you get the variable cost of goods sold?
The variable cost of goods sold. So right here, so right here, we had already calculated the average variable cost is $4.20, sorry, $420 per unit. You're okay with where that came from?
Yep.
How many units did we sell?
4,000.
Okay. So it's 4,000 times the $420 per unit. So let's answer our Part C questions here. Under the blank method, the fixed manufacturing cost included in the cost of goods sold is matched with the revenues. Under blank, all of the fixed manufacturing cost is deducted in the period in which it's incurred. So that is variable costing. Under the absorption costing method, the fixed manufacturing cost is matched with revenues. So in other words, it stays on the balance sheet until we sell it, and then it becomes part of cost of goods sold to match against the revenues from those units. Thus, when inventory increases, the blank income statement will have a higher operating income, and we saw that it was the absorption costing income statement because they moved this $30 per unit of fixed cost to the balance sheet for the 350 units that we did not sell. And so if we evaluate management performance based on the absorption costing income statement, we're essentially rewarding them for producing inventory they didn't sell, for incurring additional cost. And it's the additional cost they incurred, just to keep in mind, the additional cost they incurred was not just the $10,500. That cost would have been incurred either way, because that's a fixed cost. The additional cost that they incurred and did not need to was the $420 in variable cost for each of those 350 units they didn't sell. If they hadn't produced those units, they still would have incurred all the fixed cost, but none of the variable costs for those units. And so the impact on our operations, on our cash flow, is even more extreme than what these two income statements show. Questions, anybody? Okay, let's keep moving then. On March 31st, the end of the first month of operations, Barnard Incorporated manufactured 15,000 units and sold 12,000 units. The following income statement was prepared based on the variable costing concept. So they they produced for inventory. Their inventory increased by 3,000 units during the period. Determine the unit cost of goods manufactured based on the variable costing concept and on the absorption costing concept. Okay. So we just trying to remember what I scrolled off the screen there. We produced 15,000 and we sold 12,000. So looking at, actually, let me scroll this down just a little bit more. I'm actually going to leave it right there because I don't need to know anything about our sales, our revenues, because all we're asked to find here is the unit cost of goods manufactured. So I'm going to keep it right there so we can see everything we need. So under variable costing, we are including only the variable costs, not the fixed costs. And here's our variable cost of goods manufactured. How many units did we produce this month? 15,000. And that would give us a unit cost of $108 per unit. Whoops. Unit. So the way, because they've already presented us with the variable costing income statement, that one was pretty straightforward. Any questions about that though? And I'll plug that into our thing here in a minute. Everybody okay with that one? So for the absorption costing, we know that the full manufacturing cost includes not only the variable cost of goods manufactured, but also these fixed manufacturing costs. So in order to calculate our absorption costing per unit, whoops, there you go, I need to add together those two numbers in the red boxes. That's the total. 1,620,000 in variable costs plus 210,000 in fixed costs. Our total manufacturing cost for the period, 830,000. And again, that was for 15,000 units manufactured. Or $122 per unit. Are we suggesting then that we can just ignore fixed costs and we don't have to do anything with them? No, as a matter of fact, it's almost the opposite. Under variable costing, we are forcing the company to recognize all of those fixed costs in the period in which they're incurred without the ability to shuffle them onto the balance sheet and kind of put off recognizing those costs until a future period. Everybody good? In exercise 4, it says on April 30th, the end of the first month of operations. So they're really simplifying this for us by having no beginning inventory that we have to deal with. If we did have beginning inventory, we'd have to know for one thing, we'd have to know, are they using LIFO, FIFO, or average cost? How do we move those costs in and out of the inventory account? So they really are making this a little bit easier for us. On April 30th, the end of the first month of operations, Joplin Company prepared the following income statement based on the absorption costing concept. So this income statement is in the format that they could use for their external reporting for GAAP. What do we see here? It's their first month of operations. They made 300,000 units, but they only sold 275,000 of those units. We have an ending inventory of 25,000 units. This is the value right here. And we know that included in that number is not only their variable cost, direct materials, direct labor, variable overhead, but we also have some fixed overhead assigned to those 25,000 units under absorption costing. It tells us that the fixed manufacturing costs were 450,000. And they also tells us of the selling and administrative expenses totaling 275, 165 of that was fixed. So we're asked to take this absorption costing income statement and translate it into a variable costing income statement. So one thing we know already is that the variable costing income statement is going to have a lower income, a lower operating income, because they're going to be charged for all of the fixed manufacturing cost, not just the part that applied to the products that they sold. I'm going to pause the recording and ask you to try this on your own. And then once everyone's had a chance to do that, please restart the recording and we'll go through the answer quickly. Okay, so in this exercise 4, we were given an absorption costing income statement, and we had to convert it into a variable costing income statement. So I've included on the screen where I got my calculations, but let's just go through this. So we start with our sales. Sales are going to be the same regardless of which approach we are taking. That's based on how much we charged our customers for the product that we did sell. Under the variable costing, then we start next with variable cost of goods sold. And we're doing a 2-line display here where we have our total variable cost of goods sold. And that was total cost of goods manufactured. And that was our total cost from here minus the fixed manufacturing costs given here as 450,000. So that's where that number came from. Then I needed to subtract our ending inventory. And I took that total cost divided by the number of units that we made to find the unit cost, and then multiplied by the 25,000 units we had in ending inventory. We had produced 300,000, we only made 275,000. So 25,000 was still in ending inventory with a total value of the variable cost of 3,000. Subtracting that gives us our total variable cost of goods sold of 3.3 million. Subtract, maybe I should put a negative there. Subtract that from our sales to get our manufacturing margin. Subtract from that our variable selling expense. Where did that come from? We had our total selling and administrative here of 275. And we were told that 165,000 of that was fixed. So I subtracted the fixed from the total to get the variable. Subtract that from the manufacturing margin, we have that contribution margin. Finally, we have our fixed costs. Both of these were given right there at the top of the screen. 450 for fixed manufacturing, 165 for fixed selling and administrative, total of 615,000. Subtract that from the contribution margin gives us our operating income of 925. And as we knew would be the case, that is lower than the income under absorption costing, because under absorption costing, we shifted some of this 450,000 in fixed costs, we shifted to inventory, where on the variable costing approach, all 450,000 hits our income statement or is expensed in the period in which it's incurred. Any questions about anything? Oops, I can't really line those up. Any questions about anything from this exercise? This exercise had us go from an absorption costing to a variable costing income statement. The next exercise has us go in the other direction. It gives us the variable costing income statement and asks us to prepare an absorption costing absorption costing income statement. And so I'm going to ask you to, again, to try that on your own. I'm going to pause the recording, try it on your own, and we'll restart the recording and go through that one. Okay, so let's take a look at exercise 5. So our sales, of course, are the same as they were under variable costing. But for our cost of goods manufactured, we needed to add together the variable cost of goods manufactured and the fixed manufacturing costs from here for a total of $6,890,000. To find the value of our ending inventory, which now is going to include those fixed manufacturing costs where it did not appear, this ending inventory is only the variable costs. But now we needed to include those fixed manufacturing costs. So I divided by the number of units that were produced, 265,000, to find our per unit cost, and then multiplied by the 45,000 units that were in ending inventory. Subtracting that ending inventory from our total cost of goods manufactured for the period gives us our total cost of goods sold here. Subtract that from sales to get our gross profit. Then subtract our selling and administrative expenses, which again, we needed to combine our fixed and variable from here. Total of 430,000, leaving our operating income at 1,770,000. As we knew would happen, the absorption income is higher than the variable costing income because we've now shifted some of those fixed costs into this inventory. So this inventory, including those fixed costs, is higher than the ending inventory here that only includes the variable costs. And that is the difference between that number, 1,080,000, and this number is also the difference between our operating income under the two assumptions. Can't quite line it up now. Any questions so far? Okay. We have a nice little bit of time left, so even though we have completed 5 of our exercises, let's go ahead and move on to exercise 6. And so now that we understand the rationale behind variable costing as contrasted with absorption costing that we've known about without knowing that term, we've known about that for, since financial accounting. So now that we know that, let's take a look at how do we use this concept and to help us make decisions, to help us know how to manage and run our company more efficiently, more profitably. And so in the next several exercises, so we'll start here with exercise 6 today. We finish this exercise. We will leave the remaining exercises for our next class, which will be next Thursday. So we'll be talking about territory and product profitability analysis, segment profitability analysis. How do we use these concepts for a service company that doesn't have manufacturing overhead because they aren't making a product? And then we'll look at one final exercise to prepare a variable costing income statement for a service company. So service companies certainly can still have fixed costs. They're just not going to be manufacturing costs. Exercise 6 says, Head Pops Incorporated manufactures 2 models of solar-powered noise-canceling headphones, Sun Sound and EarBling models. The company is operating at less than full capacity. Market research indicates that 28,000 additional Sun Sound and 30,000 additional EarBling headphones could be sold. The operating income by unit of product is as follows. So you can see the breakout of the variable and fixed cost of goods sold, manufacturing costs, selling and administrative expenses there. So very important piece of information here. It tells us that they are operating at less than full capacity. And so I want to define that term capacity for you. I imagine everyone already has a sense of what that means, but I want to define it in accounting terms. And so just because we have more capacity doesn't mean we should make more product. As we've already been saying, we want to make sure there's a market for it. Can we actually sell it? And so we've done some market research and we know that we can sell some additional headphones. My assumption though, is that maybe we can't make a total of 58,000 more. We could make 28,000 more Sun Sound, 30,000 more, we could sell 28,000 more Sun Sound and 30,000 more EarBling. If we could sell them, doesn't necessarily mean we have enough capacity to make them, and we'll get to that down here. So let me define capacity for you. I'm going to give you 3 different ways of looking at capacity. So 3 different versions of what does that word capacity mean? There's theoretical capacity, practical capacity, and normal capacity. So theoretical capacity means in a perfect world, if our equipment, if our plant, if our facility could run 24/7, 365, no stoppages for vacations, the machines never break down, never need maintenance, our workers don't take breaks, we're running flat out with no slowdown, how much could we possibly make? So the theoretical capacity is, it's interesting to talk about, but it's really not going to help us make any management decisions because we don't live in a perfect world. There's no circumstance where our machines are going to run at top, full throttle, 24/7, 365. So that's not very helpful for us in decision making, although it might give us, a direction to shoot for maybe. Practical capacity, the next lower. Practical capacity is recognizing we don't live in that perfect world. How many could we make in reality? Recognizing that machines will at least need maintenance. Workers will take breaks, will take vacations. There will be a change of shift where things slow down or stop for a moment as workers change places and so on. So practical capacity is achievable, but that doesn't mean we're necessarily going to make that many, whatever it is we're making. And normal capacity is just like it sounds. That's what we expect to make. That's our typical production amount. So our typical production amount, our normal capacity, is generally going to be less than our practical capacity, which will always be less than our theoretical capacity. It is possible in very exceptional circumstances, of course, for limited periods of time that we could outproduce our practical capacity. But that's going to be, a very rare exception to the rule. Almost always our normal capacity, the amount we expect to make, is going to be at or below our practical capacity, which will always be less than theoretical. So when we talk about operating at less than full capacity, what that means is how much we are planning to produce is less than what we could produce. Maybe we don't have a third shift on, maybe we don't have any workers working overtime. Maybe we actually have some positions open that, you know, we're trying to hire some workers. And so if we had a full complement of staff, we could produce more. Maybe we're just producing less than our practical capacity because, as we've already pointed out, we don't have demand for it. So we shouldn't be producing if we don't think we can sell it. But in this exercise, they've told us we can produce more. And we now know that there might be a reason to produce more because we could sell them. Of course, there are some economic factors in play here as well. If we produce more and sell more, based on what we know about the law of demand, that price might come down, right? So we have to, just like we talked about in last class, keeps coming up. Interestingly, I was observing an economics class for another instructor yesterday, and in her class, she said, "Oh, we're talking about accounting stuff today." I said, "That's good, because I was just talking about economics and accounting." There's a lot of crossover. There's a lot of interplay between what you learn in one class and how it might apply to what you're learning in another class. Prepare an analysis indicating the increase or decrease in total profitability if 28,000 additional Sun Sound and 30,000 additional ear-bling headphones are produced and sold, assuming that there is sufficient capacity for the additional production. So, and round your answer, your per unit answers to 2 decimal places. So let me see if I can position this where we can see. If I make it that size, that still, can you still see that? Still see that up there? So what do we know? Based on what we learned in the last chapter about contribution margin, we know that our variable costs are incurred per unit, but the fixed costs are going to remain constant. If we're already covering our fixed costs with the amount of Sun Sound headphones and ear-bling headphones that we are already producing, we will know we won't increase those fixed costs by producing more. So how many more are we going to produce? 28,000 Sun Sound and 30,000 ear-bling headphones. Again, we've already covered our fixed manufacturing costs. How do I know that? Because we have an operating income. Our fixed costs are completely covered. So every additional unit of Sun Sound headphones that we produce is going to contribute $33.60 per unit. Producing those additional headphones, because it's within our practical capacity, producing those additional headphones will not increase our fixed costs. And the same thing, of course, is true for ear-bling. Ear-bling contributes just $30 to the bottom line. And so producing those additional ear-bling headphones would contribute $900,000 to our bottom line. So if we had capacity to produce these additional, both sets of additional headphones, we would increase our profitability by almost $2 million, $1.84 million. And I can make that bigger now. So let me ask you this. If we did not have capacity to produce 28,000 more Sun Sound and 30,000 more ear-bling, I'm going to tell you before I ask the question, we don't have enough data here to completely answer this question, but I just want you to think about it and we can speculate about how would we decide if we did not have capacity to produce 58,000 more headphones in total, how would we decide which one or ones to produce? What do you think would be a reasonable way to decide that? So Sun Sound, we make more per unit, right? $33.60 compared to $30 in contribution margin for Earbling. So if they take the same amount of resources, if they take the same amount of time to produce, for example, or the same amount of time, maybe we have a piece of equipment. This, I'm only mentioning this now, not because it's part of this exercise, but because it is part of business decision making, and it will come up in a later chapter as well. So I want to introduce the concept of a constrained resource. A constrained resource is something that limits our productive capacity. So it may be that we don't have enough manpower. And so maybe I gave the example that maybe we're producing below capacity right now because we just don't have enough workers. We have the equipment, but we don't have people to run the equipment. And so that limits how much we can produce. Maybe there's one machine that's really expensive, and so we can't afford to buy another one. And that machine is already being run as close as possible to 24/7, 365. So if we need that machine to produce the headphones, that's our limiting or constrained resource. And so the answer to my question about if we couldn't produce all the Sun Sound and all the Earbling headphones that we think we could sell, and the assumption is we can sell them at the going price of $140 and $128 or whatever they were. If we could not produce all of them, the way we would decide which one to produce would be by looking at what is the resource that's holding us back, that's restraining or constraining us from producing all we can sell, whether it's manpower or equipment time, or maybe it's a raw material that we just can't source enough of that raw material. That's a huge issue in business right now. I'm sure no matter how little or much attention you pay to current events, I suspect you're aware that there are supply chain issues right now. And as long as we can identify which resource, manpower, equipment, raw materials, which resource is holding us back, we would make the decision about which one of these headphones to produce based on how do we best use that constrained resource. So how much, if it's manpower, which one of these headphones takes more manpower? How much do we contribute per hour of the manpower, if that's our constrained resource? If it's equipment time, how much do we make in contribution margin per unit of that equipment time, per hour or whatever? If it's a raw material that's in short supply, which one of these uses the least raw material per dollar of contribution margin? So I just wanted to throw that out there, that it's not a matter of looking at this, and I'm glad no one jumped on it and said, well, Sun Sound produces more, whoops, sorry, I knew that was still on. Sun Sound produces more per unit, or Sun Sound produces more in total dollars of profitability. That is true, but that may not be the full picture if they take differing amounts of resources. We need to identify which resource is holding us back and how do we best use that resource. Does that make sense? Okay. All right, well, I'm going to hit the check my work button, get my green check marks in there, and clear my drawings. And we are we're a few minutes early, but that's okay. There's not time to move on to our next exercise. So we're going to stop here for today. Does anyone have any questions before I stop the recording? Let me stop the recording here.